Welcome to Money Matters. I'm David Crowell from Mortgage Network, and this is Emily Johnson from Polaris Capital. It's always our ambition each week to take world events, national events, and to reduce the consequences to Hilton Head, Bluffton, and Beaufort County. So we're going to take a shot at that once again. Interesting stuff happens every week, and it always has a trickle-down or a ripple-down effect. And that's what we try and figure out. Why don't you start, Emily, with some of what you see going on in the markets?
Okay, so anybody who has been watching any news has been hearing about the Amazon purchase of Whole Foods, and that has been kind of an all-consuming story for the last week or so. And it's interesting because of the far-reaching implications that it could actually have in a lot of different areas. But specifically what I wanted to talk about just to start out with is this theme of deflation. And so, we're always looking at inflation and sort of the expectation that certainly there's a target of about 2% that the Fed has for inflation. And that's something that, we have yet to actually accomplish. I think we're somewhere in the neighborhood of like 1.4, 1.6-ish.
Approximately 1.6.
Which it doesn't sound like it's that far off, but it basically means we're not growing the way that we should be growing. And what's interesting about what's this Amazon purchase of Whole Foods is that it could really drive the cost of food down, which is going to add further deflationary pressures to the market, which for you and I seems great because it means that our groceries are going to be less expensive.
Well, this is a wonderful example of world events that have local consequences.
We have a Whole Foods right down the street.
There's a very low rate of inflation, as you said, but there are two inflationary elements within the composite measure of inflation. One is fuel cost, the other is food cost. And
that's stuff we all actually use.
That's stuff we actually use, right, exactly. I don't use a lot of steel, except when I buy a car once every 7 years or something. But food and fuel, and food is provided. It's interesting how inflation is calculated. Inflation occurs when there's more demand than there is supply for certain goods, and the cost of the prices go up. The other way that can work is in a deflationary context. If there's an extraordinarily inefficient way of providing something, and that way of providing it becomes more efficient, then the cost can go down. So an easy example would be Amazon taking over the food industry. If they figure out a way of getting the food to us 20% cheaper, then the cost of food is going to go down.
And yet Walmart, the biggest competitor to Amazon, has actually been up to date, has been the biggest grocery store chain. It has provided more food than any other retailer. So it's interesting to sort of see that we have this behemoth of Walmart that kept prices really low, and that's what they're known for. But now we're actually going to see them go even lower.
Lower.
So that's it has some far-reaching implications. It's also they're looking at other areas that they can actually purchase goods like pharmaceuticals, that type of thing. Again, something that you use on a daily basis. So you've already seen a lot of the stocks that are related to groceries, that are related to pharma, et cetera. You've seen those stocks take a massive hit. I mean, anywhere in the neighborhood from 5 to 15%, depending on which stock we're actually looking at. In each of these companies, it's just, and it could mean losses of jobs. It could mean various other things.
It's a dislocation.
There's a yin and a yang for sure, because it's a positive in the sense that you're going to have more jingle in your pocket because you're not having to spend as much money on crackers.
But it's no one knows the outcome product by product. It's an opportunity on a stressed product to actually pay the workers more because the efficiency of the system has such a big pickup. There's if it costs I don't know, $3 to get a head of broccoli to the supermarket, and Amazon brings such efficiency to it that there's $1 of saving. There's a 33% saving. That means that maybe the price comes down 40 cents and the workers get paid more money.
And groceries are always a low margin business anyway. So
that's right.
So that's one of the factors that we've been looking at from a deflationary standpoint. The other, of course, is oil and what you see at the gas tank. And we've seen oil hanging in the low 40s here for quite a while. And again, we're hearing rumblings of maybe oil is going to go to 10, maybe it's going to go to 20. There's certainly arguments in favor of that, probably less likely than, either it's stagnating or maybe going back up to sort of that 50 number. But either way, yes, it adds a little bit more jingle again in your pocket because you have more money at the end of the month when you're filling up for $30 versus $75. However, it's still a deflationary cause, and that has, again, impacts on.
It has huge impacts. A third, to quote your very sophisticated phrase, jingle in your pocket.
It's early.
It's early in the day. Well, okay, you got to give us some break here.
Haven't checked my SAT word yet today.
There's a third source, which is mortgage money and cost of money across the board. As long as inflation is low, the cost of money is going to remain stubbornly low.
And so that also has an impact
to be the case.
On banks, which is the sort of a third piece of this puzzle that we are getting news about today, and that's the stress test. So you hear about these stress tests for years. I mean, ever since this 6, 7, 8 years now that they've had these bank stress tests. And what that does is it's a test that is it the Fed or is it the Department?
It's the Fed.
The Fed.
Mm-hmm.
So they go in and they look at if the worst case scenario happened again, like it did in 2009, 2010, 2008, 2007, if that happened again, could the banks actually make it through, and are these new regulatory requirements of having so much cash on their balance sheets adequate? And what the findings were this time is, yeah, they're adequate. They have plenty of cash on their balance sheets, but again, that kind of goes to the fact that they're not getting paid for lending. So you've really seen bank stocks stagnate. It's good that obviously they're stable based on these stress test results. However, they're not lending at mass numbers either, because if you're lending at 3.5% for 30 years, you're not looking at a very big spread. And I forget what you said, the baseline, what is it the banks have to?
The baseline, what composes an interest rate or core interest rate is the price at which banks can borrow money, which right now is 1.25% from the Fed window. If you're a big enough bank, you can go to the window of the Fed and buy at 1.25%, between 1 and 1.25. Add to that, so that's the price at which the bank gets to borrow. Add to that inflation, and inflation is approximately 1.6. So cost of borrowing for the bank plus inflation is about 2.8.
Then they have operations.
Then they have operations and profit. That takes it up to about 3% above that. 2.8 plus 3%, let's say it's 5.8%. So all of the old economic models that are tried and trusted and tell us where interest rates are going say 5.8.
And yet that's not what's
the
happening.
Case.
So you're not borrowing at 5.8, you're borrowing at what, 4?
3.8.
Right, 3.8 for 30 years. So that means the bank's not making money. The spread's not there.
That spread's not there. And that means that when your investors in your financial advisory business try to buy bonds and get good yields,
right,
the yields are very low.
Right, in fact,
it's all part of the same cycle of inflation and yield.
We've actually seen, and we've been using some more actively traded bond managers, because that's really where you can get that extra yield in bonds, because the yields, especially if you're looking at munis, most people are sort of sticking in sort of that mid-term range when it comes to bonds, sort of the 5 to 10 year, 5 to 10 year range, maybe about a 5-year duration or something. So it's kind of hanging in there. They don't yield much. I mean, I think your average yield on something like that is going to be somewhere in the neighborhood of 2 if you have, if you're getting good bonds and you're buying them right, which most people can't do it on the retail level because there's so much fat baked into the bonds, you just don't even see it. But if you're actually buying them right, you can actually add some additional percentage points on that. So we're actually seeing active bond managers, which it's still a little dicey, there's still some risk to it, but we're seeing them coming in somewhere around 5%. So they're getting yields somewhere in the neighborhood of 2 to 3, but then they're throwing another 1.5 to 2% on top of that from actively going in and buying secondary issues and selling them, which didn't used to be the case. It used to be a bond ladder was kind of the way to do things, and we still use bond ladders because they're cheap, they're easy, and you know how it's going to work. But we're seeing a lot more actively traded bonds now too, because that's the only place to actually add that extra juice. Another very sophisticated term.
Another aspect of the interrelationship between interest rates, yields, and in the growth of the economy is where the economy is going and what impact it can have on that complex. The entire budgeting currently being done by the government and the tax cuts that are proposed that are unfunded, the massive changes that have been proposed in the economy we'll talk about next time because it relates directly to this same complex.
Okay, well, we'll kick off with that in the second half of the show, so please stick with us. We'll be right back with more Money Matters.